Hey everyone, and welcome to our crash course on, well, not literally crashing, but on understanding the sometimes confusing world of insurance. We're going to be your guides on a journey through the legal jungle of insurance contracts, hacking through the jargon and emerging, hopefully, a little wiser. Over the next several videos, we'll unpack 36 key legal concepts. Think of these concepts as the building blocks of every insurance policy, from your car insurance to your health insurance. Now, you might be thinking, John, legal concepts, isn't insurance all about numbers and risk? And you wouldn't be entirely wrong, but beneath those numbers and probabilities lies a foundation of legal agreements that dictate how insurance actually works. Understanding these concepts can empower you to make informed decisions about your coverage, avoid common pitfalls, and maybe even win an argument with your insurance company, though no promises on that last one. So whether you're a seasoned insurance professional looking for a refresher or a curious individual just starting to explore the world of coverage, this series is for you. We'll break down each concept into bite-sized pieces, using real-world examples and maybe even a few terrible jokes along the way. Buckle up, because things are about to get legal, but in a fun, informative way, I promise. Our first legal concept throws us right into the thick of things with the concept of adhesion. Don't worry, it's not as sticky as it sounds. In the world of insurance, a contract of adhesion refers to the fact that the insurance company, not you, gets to write the contract. You, as the policyholder, essentially adhere to their terms. It's a bit like joining a club where the rules are already set in stone. You can choose to join or not, but you can't really negotiate the rules themselves. This take-it-or-leave-it approach might seem a little unfair at first glance, but there's a method to the madness. Insurance companies need standardized contracts to manage risk effectively across a large pool of policyholders. Imagine if everyone could haggle over their own individual terms. It would be chaos. However, this system does place a greater responsibility on the insurance company to ensure that their contracts are clear, fair, and easy to understand. Now, you might be wondering what happens if there's a disagreement about the contract terms. That's where the concept of ambiguities comes into play. But we'll save that juicy detail for a later chapter. The important thing to remember about adhesion contracts is that they highlight the importance of carefully reading and understanding your insurance policy before you sign on the dotted line. So, we've talked about contracts of adhesion, but who are the people who present these contracts to you? Enter the insurance agent, a key player in the insurance ecosystem. These individuals act as intermediaries between you, the insurance seeker, and the insurance company, the risk taker. Think of them as matchmakers, helping you find the right coverage for your needs from among the many options available. But agents are more than just salespeople. They have a fiduciary responsibility to both you and the insurance company. This means they have a legal and ethical obligation to act in the best interests of both parties. It's a delicate balancing act, like walking a tightrope while juggling flaming torches. They need to make sure you get the coverage you need at a price you can afford, while also ensuring that the insurance company can manage its own risk. Now, it's important to note that not all insurance professionals are created equal. There are different types of agents, each with their own set of allegiances and responsibilities. Some agents, known as captive agents, represent a single insurance company. Others, called independent agents, work with multiple insurers, offering you a wider range of choices. Understanding the difference can help you determine whose interests an agent might prioritize. In the next chapter, we'll delve into the concept of aleatory contracts, which adds another layer of complexity to the insurance equation. But for now, just remember that your insurance agent can be a valuable resource when navigating the world of insurance. Don't be afraid to ask questions, shop around for the best deal, and make sure you understand the terms of any policy before you commit. All right, let's dive into a concept that makes insurance a bit of a gamble, in a way. It's called aleatory. And it basically means that the value exchanged between the insured and the insurer might not be equal. Think about it. You could pay your premiums diligently for years and never file a claim. On the flip side, someone could get into a fender bender a week after getting car insurance, making a claim that costs the insurer way more than they've paid in premiums. That's the nature of the beast. With insurance, it's all about managing risk, both for you and the insurance company. This element of chance is woven into the very fabric of insurance contracts. It's what makes it possible for insurance companies to protect a large group of people from financial hardship. It's like a safety net, but the net itself costs money to maintain, even if you never actually fall into it. So, while it might feel a bit weird to think about insurance as this potentially lopsided agreement, remember that it's this very characteristic that allows it to function in the first place. It's the sharing of risk with the understanding that some will pay more in and use less, while others might pay less and need to rely on the coverage more. Let's talk about something you never want to encounter in your insurance contract: ambiguities. Ambiguity is basically legal jargon for unclear or open to interpretation. And trust me, when it comes to insurance contracts, you want everything to be crystal clear. The problem with ambiguities is that they can lead to disputes down the line. If a term or condition in your policy is vague, you and your insurer might have very different interpretations of what it actually means. This can become a major headache if you need to file a claim and the insurer denies it based on their understanding of the ambiguous language. Remember that principle of adhesion we talked about earlier? Well, ambiguity is tied directly into that. Since insurance contracts are drafted by the insurer, any ambiguity in the language is generally interpreted in favor of the insured. Courts tend to side with the party who didn't write the contract, assuming they didn't have the opportunity to negotiate the terms. So, while it might seem like a minor detail, ambiguous language in an insurance contract can have significant consequences. Always make sure you understand the terms and conditions of your policy, and don't hesitate to ask your agent or insurer for clarification if anything seems unclear. Okay, time for a concept that's a little tricky but super important. Apparent authority. This is all about the impression that's given to the insured, even if it's not the complete reality of the situation. Imagine you walk into an insurance agent's office and they're sitting there behind a big desk, company logo everywhere, maybe even a nameplate that says Senior Insurance Guru or something. You'd naturally assume they have the authority to do, well, insurance agent things, right? That's apparent authority in a nutshell. It's the idea that the insurer, through their actions or inactions, has created a reasonable belief in your mind that the agent has the power to act on their behalf. Now, this doesn't mean that any random person can just slap on a name tag and start selling insurance policies. The insurer has to have done something to give you that impression. Maybe they gave the agent official-looking documents, let them use company branding, or even just didn't correct you when you called them Agent Awesome. The thing is, even if the agent steps outside their actual authority, if you, as a reasonable person, believed they were acting within their rights based on the image the insurer projected, the insurer might be bound by the agent's actions. It's all about fairness and making sure that people aren't taken advantage of based on misleading appearances. So we've talked about agents who represent the insurance companies, but what about brokers? Well, think of brokers like insurance matchmakers. They work for you, the consumer, helping you navigate the often confusing world of insurance policies. Unlike agents, brokers don't have a direct tie to any specific insurance company. They're like free agents of the insurance world. This means they can shop around on your behalf, comparing policies from multiple insurers to find the coverage that best fits your needs and budget. It's important to remember that while brokers are there to help you, they also can't bind coverage on behalf of an insurer. They're like the middleman who introduces you to the insurance company and helps you find the right fit, but ultimately it's up to the insurer to decide whether to offer you coverage. So agents are like the company store and brokers are like venturing out into the wider world of insurance options. Both have their pros and cons, and the best choice for you will depend on your individual needs and preferences. All right, let's talk about a crucial concept in contract law, and that's the idea of a competent party. Now, this isn't just about being good at understanding insurance jargon, though that would be impressive. It's about meeting specific legal requirements to enter into a contract, including an insurance policy. To be considered a competent party, you need to tick a few boxes. First off, you've got to be of legal age, which varies depending on where you live. Secondly, you need to be mentally capable of understanding the contract's terms. And finally, sorry to be a buzzkill, but you can't be under the influence of drugs or alcohol when signing on the dotted line. These requirements exist to protect everyone involved. For the insurer, it ensures they're dealing with someone who understands the agreement. For you, it prevents you from agreeing to something you wouldn't have otherwise if you were thinking clearly. So, if you're ever unsure about your capacity to enter into a contract, maybe due to age or mental state, it's always a good idea to consult with a legal guardian or advisor. It's better to be safe than sorry, especially when it comes to something as important as insurance. We've all been tempted to omit certain details when filling out forms, like maybe exaggerating our height on our driver's license. But when it comes to insurance, honesty is truly the best policy. Why? Because concealing or hiding crucial information from your insurer can have some serious consequences. This brings us to the concept of concealment. In the insurance world, this refers to the act of intentionally withholding material facts when applying for coverage. Now, what exactly is a material fact? It's any piece of information that could influence the insurer's decision to offer you coverage or affect the price of your premiums. Let's say you have a history of heart disease in your family, but you decide not to disclose it when applying for life insurance, hoping to snag a lower premium. If the insurer later discovers this omission, they could potentially deny your claim or even void your policy altogether. Remember, insurance is all about trust and transparency. By being upfront and honest with your insurer, you're protecting yourself and ensuring that you'll have the coverage you need when you need it most. All right, let's talk about insurance contracts and why the word conditional is so important to them. You see, unlike a contract to buy a pizza where you pay your money and get your pizza, insurance contracts are a little more, shall we say, nuanced. An insurance contract is conditional because the insurer's promise to pay benefits hinges on a very specific thing, the occurrence of an event that's actually covered by the contract. This means you can't just say, my car feels a little blue today, time for a payout. The event, whether it's a car accident, a house fire, or, well, something else that we cover in a life insurance policy, has to fit the bill, and this is where things get really interesting. And by interesting, I mean where we separate the good insurance policies from the not-so-good ones. You see, the clarity of the contract's language in defining these covered events is crucial. A vaguely worded contract can lead to disputes, and let's be honest, nobody wants to end up in court arguing over the definition of accidental. So remember, folks, when you're shopping for insurance, don't just skim over the terms and conditions. Pay attention to what is and isn't covered, because as we've established, these contracts are conditional, and understanding those conditions can make all the difference. Okay, we've talked about how insurance contracts are conditional, but let's face it, all contracts involve conditions. What makes insurance contracts stand out? Well, to understand that, we need to dive into the fascinating world of consideration. Now, I know what you're thinking, John, this is insurance, not a Jane Austen novel. When do we get to the romance? Well, my friend, in the realm of legal contracts, consideration doesn't involve longing glances or whispered confessions. It's much more practical and, dare I say, even more exciting. Consideration in this context refers to the exchange of value. Both parties involved in the contract need to bring something to the table. In an insurance contract, you, as the policyholder, are offering up two very important things: accurate information about yourself and, of course, those lovely premium payments. In return for your honesty and your hard-earned cash, the insurance company pledges to hold up their end of the bargain. And by that, I mean they agree to cover the costs of any legitimate claims that fall under the policy. It's a beautiful dance of trust, responsibility, and just a smidgen of calculated risk. All right, we've established that consideration is the bedrock of any insurance contract. But where, you might ask, is this grand exchange of value documented? Well, my inquisitive friends, that's where the consideration clause struts onto the stage, contract in hand, ready to steal the show. Now, I know, clauses might not sound like the most thrilling topic of conversation, but trust me on this one. This little clause is like the VIP section of your insurance contract. It's where all the juicy details about your financial obligations and the insurer's promises are spelled out in black and white. Think of it like this. The consideration clause is where the rubber meets the road, where abstract promises transform into concrete terms. It outlines the nitty-gritty, like the initial premium amount, the frequency of those delightful premium payments, monthly, quarterly, annually, take your pick, and any delightful surprises you might encounter upon renewal. So, the next time you're reviewing an insurance contract, don't just gloss over the consideration clause. Take a moment, grab your metaphorical magnifying glass, and appreciate the beauty of its clarity. Because, my friends, in the world of insurance, the devil and the angels reside in the details. So you thought you were getting full coverage on your car, the works. Turns out reading the fine print is not just for lawyers and people who enjoy boredom. This is where the doctrine of reasonable expectations swoops in, wearing a cape of common sense. Basically, this doctrine says that if a reasonable person expects something to be covered by their insurance, even if the contract itself isn't crystal clear about it, the courts are likely to side with the reasonable person. It's like the legal system saying, yeah, that insurance jargon can be confusing, we get it. But hold on, this doesn't mean you can just claim ignorance and expect a payout for anything and everything. The expectation still has to be, reasonable. Like, if your policy clearly says it covers damage from falling trees, but not meteorites, you can't exactly cry doctrine of reasonable expectations. When your car gets totaled by space debris, the courts might not be as sympathetic. This doctrine is really about fairness and making sure insurance companies aren't pulling a fast one with confusing language and hidden clauses. It's a reminder that insurance, at its core, is about protecting people, and sometimes that means cutting through the legal mumbo-jumbo to get to the heart of what's reasonable. All right, let's talk about estoppel. Sounds kind of fancy, right? Like something a lawyer would dramatically yell in court. But it's actually a pretty straightforward concept, and it's all about accountability. Basically, estoppel is like the legal version of you said it, you own it. Imagine this, you're buying car insurance, and you specifically ask the agent if your policy covers driving for a ride-sharing app. The agent, may be distracted by a particularly fascinating pigeon outside the window, casually says, yeah, you're good. You, relieved, sign on the dotted line. Fast forward a few months and bam, you get into a fender bender while chauffeuring someone around town. You file a claim feeling pretty confident until the insurance company hits you with the dreaded denial. Turns out your policy explicitly excludes ride-sharing. Bummer. But wait, remember that agent who was more interested in pigeons than your insurance needs? That's where estoppel swoops in. Because the agent who represents the insurance company made a promise, even if it was an absent-minded one, the company might be estopped from denying your claim. Essentially, they're prevented from going back on their word, even if it was a mistake. Estoppel is all about making sure that people are held responsible for the information they provide, especially when others rely on that information to make decisions. Let's talk about authority. And no, not the kind your parents threatened to ground you without. We're diving into the world of express authority in the insurance realm, where clarity reigns supreme. Imagine this. An insurance agent is like a superhero, but instead of a cape, they have a contract that outlines their superpowers, aka their express authority. This contract, bestowed upon them by the almighty insurance company, explicitly states what the agent can and cannot do. Think of it as a detailed job description, but instead of making copies and fetching coffee, they're making promises on behalf of the insurance company. So let's say this contract clearly states that our superhero agent has the express authority to sell you a specific type of car insurance policy. They can quote you rates, explain the coverage, and even finalize the deal with a triumphant flourish of their pen. You walk out feeling secure, knowing you're protected. But what if the agent goes rogue and tries to sell you a life insurance policy, even though their contract doesn't give them the express authority to do so? This is where things get messy. Because they're acting outside the bounds of their written authority, the insurance company might not be obligated to honor that policy. Express authority is all about setting clear boundaries and ensuring that everyone understands who has the power to do what. It's like the rule book of the insurance game, making sure everyone plays fair and square. Okay, so we've talked about agents and brokers, but let's dive into the concept of a fiduciary. This is a big one, folks. Imagine someone entrusted with something incredibly valuable. It could be an ancient artifact, a winning lottery ticket, or in our case, someone's financial well-being. That's a fiduciary. In the world of insurance, a producer, whether an agent or a broker, acts as a fiduciary for both the people buying insurance and the insurance companies themselves. Think about it. You're handing over your hard-earned money in the form of premiums, trusting that they'll be managed responsibly and that you'll be taken care of if disaster strikes. It's a relationship built on trust. Now, this trust isn't just some handshake agreement. It's backed by legal and ethical obligations. A fiduciary is legally bound to act in the best interest of their clients, putting their needs before their own. This means offering honest advice, even if it means a smaller commission, and always being transparent about where your money is going and how it's being used. So next time you hear fiduciary, think of it as the insurance industry's version of a superhero oath. With great power comes great responsibility. It's a reminder that this business is about more than just policies and premiums. It's about protecting people and their futures. All right, let's talk about something nobody really enjoys discussing, but that's essential to understand in the world of insurance fraud. Now, we're not talking about your everyday white lies here, like telling the dentist you floss every day. We're talking about deliberate deception for personal gain, and in insurance, that's a big no-no. Imagine this. Someone reports their car stolen to their insurance company, claiming they lost their vintage record collection in the process. Sounds awful, right? But what if that car was conveniently stolen right before it was about to fall apart? Or worse, those records never existed in the first place. That's insurance fraud, my friends, and it comes with serious consequences. Fraud isn't just about making false claims. It can also involve lying on your insurance application. Maybe you downplay your love for extreme sports when applying for life insurance, or conveniently forget to mention that fender bender from last year. These might seem like small things, but they can be considered material misrepresentations, and that's a whole other can of worms. Why is all of this such a big deal? Well, insurance relies on a foundation of honesty and trust. When people cheat the system, it drives up costs for everyone. Plus, insurance fraud is illegal and can lead to hefty fines, a criminal record, and even jail time. So, remember, honesty is always the best policy, literally. We've talked about express authority, where an insurance agent's powers are clearly outlined in writing, but what about those situations where things aren't so explicitly stated? That's where implied authority comes into play. The kind of authority that, while not written down, is simply understood to be part of the job. Think of it like this. You walk into a restaurant and a host leads you to a table. You don't need a written contract to know they have the authority to do that, right? It's just common sense, a natural part of their role. The same goes for certain actions taken by insurance agents. Let's say you need to change the address on your auto insurance policy. You call up your agent and they take care of it for you. Now, the agency contract might not specifically list changing addresses as one of their duties, but it's implied that they have the authority to handle such routine tasks on behalf of the insurer. Implied authority exists to keep things running smoothly. It allows agents to respond to your needs efficiently without needing permission for every little thing. However, it's important to remember that implied authority has its limits. An agent can't just decide to write you a blank check from the insurance company's account, right? Those are actions that would require explicit written authorization. So while implied authority might seem a bit like navigating a world of unspoken agreements, it's really about applying common sense and understanding the usual scope of an agent's role within the bounds of their relationship with the insurer. Hey everyone, and welcome back to Crash Course Insurance. Today we're diving into the nitty-gritty of indemnity contracts. Now, the word indemnity might sound a bit intimidating, but it's really just about putting you back in the same financial position you were in before a covered loss. Think of it like this. Let's say your house is damaged in a fire. An indemnity contract, in this case your homeowner's insurance, aims to restore your home as much as possible to its pre-fire glory, covering the costs of repairs or rebuilding. This principle of restoring you to your previous financial state is a cornerstone of many insurance types. Whether it's car insurance covering the cost of repairs after an accident or health insurance covering medical bills, the goal is to make you whole again financially. Of course, there are limits to how much an insurance policy will pay out, and those limits are clearly outlined in your policy documents. But the key takeaway here is that indemnity contracts aren't about making a profit from a loss. It's not like winning the lottery. Instead, they're about providing a safety net, a way to bounce back from unexpected events without facing a devastating financial blow. So next time you hear the term indemnity contract, remember it's all about getting you back on your feet, financially speaking. All right, Crash Course fans, let's talk about a concept that's crucial to understanding the world of insurable interest. Now, when we talk about insurance, we often think about protecting our stuff, right? Our homes, our cars, our prized possessions. But insurable interest goes beyond just owning physical objects. It's about having a legitimate financial stake in something, a reason why its loss or damage would cause you genuine financial hardship. Think about it this way. You can't just go around insuring random people's houses or cars hoping they'll burn down or crash so you can collect a payout. That would be not only unethical, but also illegal. You need to have a valid reason, a financial interest, to be able to insure something. And this interest can take many forms. It could be your home, your business, even your own life. But here's where it gets interesting. Insurable interest also extends to relationships. Spouses, for example, have an insurable interest in each other's lives because the loss of one partner could lead to financial strain for the other. Parents have an insurable interest in their children, and business partners have an insurable interest in each other's businesses. So the next time you're thinking about insurance, remember, it's not just about stuff, it's about protecting what matters, what you have a genuine stake in. All right, Crash Course crew, in this episode we're tackling a fundamental document in the world of insurance, the insurance policy. Now, I know what you might be thinking. Insurance policies, those lengthy jargon-filled documents that we file away and hope to never read. Well, as tedious as they may seem, insurance policies are actually pretty important. They lay the groundwork, the rules of the road, for the entire insurer-insured relationship. In essence, an insurance policy is a legally binding contract between you, the policyholder, and the insurance company. It outlines the terms of coverage, the promises made by both parties. Think of it as a two-way street. You, the policyholder, agree to pay premiums, those regular payments that keep your coverage active. In return, the insurance company promises to pay for covered losses as outlined in the policy should those unfortunate events occur. But insurance policies are much more than just a promise to pay. They're incredibly detailed documents that specify exactly what is and isn't covered. They outline the types of risks that are insured against, be it a car accident, a house fire, or a major illness. And they set limits on coverage, both in terms of how much the insurer will pay and under what circumstances they'll pay. So while we might not enjoy reading them, understanding the ins and outs of your insurance policy is essential to ensure you're adequately protected. All right, let's talk about something called legal purpose in the world of insurance. This might sound obvious, but an insurance contract has to be for something legal. You can't, for instance, take out a life insurance policy on someone you plan to. Well, you get the idea. And it's not just about outright criminal activity. The contract can't go against what we call public policy. So you can't have an insurance policy that encourages reckless behavior. Like, imagine if you could get car insurance that specifically covered you for driving under the influence. That would be a big flashing neon sign saying, go ahead, drive drunk, not good for anyone. The idea here is that insurance should promote good, responsible behavior, not encourage people to take unnecessary risks. After all, the whole point of insurance is to provide a safety net, not to give people a free pass to act recklessly. So, when an insurance company puts together a contract, they need to make sure it's all above board, legally speaking. And we, as savvy consumers of insurance, need to understand that this principle exists to protect everyone involved. Let's talk about honesty for a second, because in the insurance game, it's not just the best policy, it's kind of the whole point. We call this material misrepresentation, and it's a big deal. Basically, it means you give the insurance company false information that actually matters when they're deciding whether or not to insure you. Think of it this way. You're buying a car, right? You wouldn't tell the seller it's never been in an accident if you'd just driven it through a brick wall, would you? The same principle applies to insurance. If you tell your health insurer you're a non-smoking marathon runner when you actually chain smoke a pack a day and haven't run a mile since high school, that's a problem. Why? Because that information is crucial for the insurance company to assess the risk they're taking on. They use it to determine your premiums, what they'll cover, and even whether they'll insure you at all. It's all about accurately evaluating the odds. So when you fill out those insurance applications, remember, honesty is not just the best policy, it's the only policy that'll actually protect you in the long run. We just talked about material misrepresentation, but now let's zoom out a bit and talk about misrepresentation in general. Because even seemingly small fibs can have big consequences in the insurance world. Now, a misrepresentation is basically any statement you make that isn't entirely true, even if it seems insignificant at the time. It might be intentional, like trying to get a lower premium, or it could be a simple mistake or oversight. But either way, it can come back to bite you. Think of it like this. You're baking a cake, and the recipe calls for a teaspoon of salt. Now, you might think, a little extra salt won't hurt, and accidentally add a tablespoon. Sure, the cake might still be edible, but it's not going to taste quite right. Similarly, even small inaccuracies on your insurance application can throw things out of whack. Maybe you got your address slightly wrong, or forgot to mention a minor fender bender from years ago. These things might seem trivial, but to an insurance company they can be red flags. Why? Because insurance is all about trust and transparency. The insurer is relying on you to provide accurate information so they can assess the risk and provide you with the right coverage. So, always double-check those forms, folks. And remember, when it comes to insurance, the truth will set you free from potential headaches down the line. All right, let's talk about the parole evidence rule. Sounds kind of fancy, right? Like something you'd hear in a courtroom drama. And you know what? It is something you'd hear in a courtroom because it's a legal rule. But don't worry, it's not as complicated as it sounds. Basically, this rule says that when you have a written contract, like an insurance policy, any previous verbal agreements or promises don't really matter. Think of it like this. You and your friend agree to meet for coffee at 3 p.m. You even text to confirm, coffee at 3, see you there. But then your friend shows up at 2 p.m. claiming you'd said 2 p.m. on the phone earlier. Frustrating, right? The parole evidence rule would be on your side here. That text message, that's your written agreement, and it trumps any prior conversations. In the context of insurance, this means that if something isn't written down in your policy, it's really hard to prove it was agreed upon. So if your agent verbally promised you a lower deductible, but it's not reflected in the written policy, you might be out of luck. This is why it's crucial to read your insurance policy carefully. And hey, maybe even take notes, highlight important sections, channel your inner bookworm, because at the end of the day, the written word holds a lot of power, especially when it comes to legal contracts. So remember, when it comes to insurance, if it's not in writing, it's like that awkward middle school dance, it never happened. Okay, so you've got your insurance policy, right? It's a whole contract outlining what's covered and what's not. But life is complicated, isn't it? Sometimes you need a little extra something tailored to your specific needs. That, my friends, is where policy riders or endorsements come in. They're like the sidekicks of the insurance world, adding an extra punch to your coverage. Think of it like ordering a pizza. You've got your basic cheese pizza, that's your standard policy. But maybe you're a mushroom lover or you need a gluten-free crust. Riders are like those extra toppings or modifications. They let you customize your policy, adding coverage for specific items or situations that your standard policy doesn't cover. Say you're a musician with a super expensive vintage guitar. Your standard renter's insurance might not cover its full value, but you can get a rider specifically for that guitar, ensuring it's protected in case of theft, damage, or a very enthusiastic mosh pit. Of course, these extra toppings usually come with an extra cost. Just like adding pepperoni to your pizza will increase the price. Adding riders to your policy usually means a higher premium. But hey, peace of mind knowing your prized possessions are fully protected, that's priceless, right? So next time you're reviewing your insurance, remember the power of riders. They might be small, but they can make a world of difference. Okay, let's talk about reasonable expectations in insurance. This isn't just about hoping your insurance company will be nice. It's an actual legal principle. Basically, it means that when you buy an insurance policy, you should be able to reasonably expect a certain level of coverage. Think of it like this. You buy a fire extinguisher, you'd reasonably expect it to work in case of, a fire, right? You wouldn't expect to have to fight the flames with a bucket of water while holding a useless hunk of metal. Insurance works in a similar way. You pay your premiums, and in return, you reasonably expect the insurance company to hold up their end of the bargain when you need to make a claim. Now, reasonable is a bit subjective, right? What's reasonable to one person might seem outrageous to another. That's where things can get a bit tricky. But generally speaking, courts will look at what a typical, sensible person would expect from a particular type of insurance policy. So if your basement floods and your insurance company tries to deny your claim because of some obscure clause hidden in the fine print, a court might side with you, especially if a reasonable person wouldn't have understood that exclusion. The bottom line: insurance policies shouldn't be a game of gotcha. They should provide a reasonable level of protection for the things that matter most. Hey everyone, and welcome back to Demystifying Insurance. Today we're diving deep into the world of representations. Now, you might be thinking, don't we make representations all the time? And you'd be right. But in the land of insurance, representations have a very specific meaning. Essentially, a representation is a statement made by the applicant for insurance. That's you, potentially, that they believe to be true to the best of their knowledge. Think of it like filling out an application form. You're asked about your age, health history, maybe even your driving record. You're expected to answer honestly, but you're not expected to be infallible. The key here is that representations are based on what you know at the time. Let's say you're asked if you've ever had a speeding ticket and you genuinely can't recall that time you were running late for a history exam back in high school. That's okay. Representations aren't about perfect recall, they're about honesty and good faith. Now, you might be wondering, what happens if I make a mistake on my application, even if it's unintentional? Well, that's where things can get a little tricky. If the misrepresentation is considered material, meaning it could have influenced the insurer's decision to offer you coverage or the price they offered, it could potentially lead to your policy being voided. Don't worry though, we'll get into the nitty-gritty of material misrepresentation in a later episode. All right, folks, buckle up because today we're tackling a concept that sounds way more complicated than it actually is: the rule regarding ambiguities. Now, remember how we talked about insurance contracts being contracts of adhesion? That whole take it or leave it situation. Well, this rule comes into play when those contracts aren't as crystal clear as they should be. You see, sometimes insurance policies can have terms or phrases that are open to interpretation. Maybe a word has multiple meanings, or a sentence could be read in a couple of different ways. That's what we call ambiguity. And when it comes to insurance contracts, the courts have a pretty clear stance. If there's ambiguity, the benefit of the doubt goes to the insured. That's you. This rule exists because, let's face it, insurance companies are the ones writing these contracts. They have teams of lawyers crafting the language, and it's not always easy for the average person to decipher every single clause. So, if a dispute arises and the court finds the contract to be ambiguous, they're going to side with the interpretation that favors the policyholder. This doesn't mean you should just skim through your policy and assume everything will work out in your favor. It's still super important to read through your coverage carefully and ask your agent or broker any questions you might have. But it does provide a layer of protection, ensuring that insurance companies are held accountable for using clear and concise language in their policies. Hey there, insurance aficionados. Today we're delving into the world of subrogation, and no, it's not a new type of yoga. In the simplest terms, subrogation is the right of an insurance company, after paying a claim to the insured, to then pursue the third party responsible for the loss. Think of it like your insurance company stepping into your shoes to recover the money they paid on your behalf. Let's say you're driving down the road minding your own business when, bam! Someone runs a red light and totals your car. You file a claim with your insurance company, they cover the damages, and you breathe a sigh of relief. But the story doesn't end there. See, your insurance company isn't just going to let the at-fault driver off the hook. They have the right to subrogate, to go after that driver, or more likely their insurance company, to recover the costs they incurred by paying your claim. Now you might be thinking, why should the insurance company get to double dip? They already got their money back from the other driver's insurance, and that's a fair point, but subrogation serves a few important purposes. First, it helps keep insurance premiums down for everyone by recovering costs from at-fault parties. Insurance companies can offset some of their expenses, which ultimately benefits policyholders. Second, it helps ensure that the responsible party is held accountable for their actions. Without subrogation, the at-fault driver might walk away from the accident without facing any financial consequences, even though they caused the damage. Subrogation helps ensure that justice, at least in the financial sense, is served. Okay, so we've talked about a lot of complex terms in insurance, but let's break down one that's pretty straightforward: unilateral. And no, it has nothing to do with unicycles, though I applaud your enthusiasm for circus arts. In the world of contracts, unilateral just means that only one party is making an enforceable promise. Think of it like this. You promise to pay your car insurance premium every month, and in return, the insurance company promises to pay out if, you accidentally drive into a lake or something. You're both holding up your end of the deal, but only the insurer is bound to perform if something specific happens. This one-sided promise situation might seem a little unfair, but it's actually pretty crucial to how insurance works. It allows insurance companies to pool resources from many policyholders and pay out those who experience covered losses. Even if those losses are way bigger than the premiums they paid, it's kind of like a collective safety net where everyone chips in a little bit, knowing that if something bad happens, the insurance company is legally obligated to be there for them. And hey, that's a promise worth paying for, right? All right, let's talk about trust. Or more specifically, utmost good faith, a principle that's pretty much the bedrock of the entire insurance industry. It's like the golden rule of insurance, except instead of treating others how you want to be treated, it's all about being radically honest with each other. Basically, utmost good faith means that both you, the policyholder, and the insurance company are expected to be totally upfront and transparent throughout the entire insurance process. We're talking full disclosure, no hiding secrets, no burying information in a metaphorical or literal backyard. Think about it. Insurance companies make decisions about who to insure and how much to charge based on the information you provide. If you conveniently forget to mention that you enjoy racing your pet turtle on weekends, well, that's kind of a big deal, right? On the flip side, insurers are also bound by this principle. They can't just spring surprise exclusions or hidden clauses on you after you've signed on the dotted line. It's all about fostering a relationship built on honesty and transparency, because let's be real, nobody likes nasty surprises, especially when it comes to insurance. So far, we've navigated a labyrinth of insurance jargon, but fear not, intrepid learners, for we've arrived at a concept that's refreshingly straightforward: the valued contract. And no, it doesn't involve appraisers with monocles determining the value of your antique rubber duck collection. In the world of insurance, a valued contract is simply an agreement where the payout amount is predetermined and agreed upon at the outset, regardless of the actual loss incurred. It's like ordering a pizza. You know exactly how much you're paying and you know exactly how much pizza you're getting, even if you only end up eating half of it. Now, where do we typically encounter these valued contracts? Well, my friends, look no further than the realm of life insurance. Unlike, say, car insurance, where the payout depends on the extent of the damage, a life insurance policy pays out a fixed sum upon the policyholder's death, regardless of whether their passing was caused by a tragic paper cut or something more, shall we say, dramatic. This predetermined payout provides a sense of certainty and security, allowing policyholders to rest easy, knowing that their loved ones will receive a specific amount of financial support when they're gone. Because let's be real, putting a price tag on a human life is impossible, but ensuring financial stability for those left behind, that's something we can definitely put a value on. All right, let's talk about contracts that are about as real as those ghost sightings on those paranormal investigation shows. Void contracts. Imagine you're trying to get insurance, but instead of going yourself, you send your identical twin with a fake moustache. Sounds ridiculous, right? Well, that's essentially what happens in a void contract situation. One of the essential elements of a contract is missing, making it invalid from the get-go. It's like trying to bake a cake without flour. No matter how much you want it to be a cake, it's just not going to happen. A common example of this in insurance is when someone provides false information during the application process. Remember that whole utmost good faith thing we talked about? Yeah, this is where that comes into play. If an insurer discovers that a contract was void from the beginning, they can retroactively deny coverage, leaving you in a very vulnerable position. So the key takeaway here is this. Don't try to outsmart the system. Be honest and upfront during the application process, because a void contract is about as useful as a screen door on a submarine. Now, let's move on to a slightly different but equally precarious situation. Voidable contract. Unlike void contracts, which are null and void from the start, voidable contracts are valid agreements, at least initially. Think of it like this. You buy a house, sign all the paperwork and move in, only to find out later that the seller didn't actually own the property. Yikes. In insurance, a voidable contract typically arises when one party, usually the insurer, has the right to cancel the agreement due to certain circumstances. This could be because of misrepresentation or concealment of important information during the application process. For instance, if you tell your insurer you're a non-smoker when you actually chain smoke a pack a day, that's a big no-no. The insurer can choose to void the contract, especially if they discover this discrepancy when you try to file a claim. However, it's important to note that not all misstatements or omissions will automatically make a contract voidable. The insurer has to prove that the withheld information was material to the risk being insured. The difference between void and voidable contracts can be a bit tricky, but the main thing to remember is this. A void contract is invalid from the start, while a voidable contract is initially valid but can be voided later on under certain circumstances. So be honest, read the fine print, and don't try to pull a fast one on your insurer. After all, a little honesty goes a long way in the world of insurance. All right, let's talk about waivers. Now, you've probably signed a waiver at some point, maybe for a bouncy house, a go-kart track, or even just to join your school's photography club. Essentially, a waiver is when you voluntarily give up a legal right. You're acknowledging a potential risk and agreeing not to hold someone responsible if things go south. In the context of insurance, a waiver might come into play if, for example, you agree to a lower premium in exchange for waiving your right to certain types of coverage. It's important to understand exactly what you're giving up before you sign on the dotted line. Think of it like agreeing to use the training wheels on your bike forever. It might seem easier in the moment, but it could limit your options down the road. Waivers can get a little complicated, legally speaking. They need to be clear, specific, and agreed to knowingly and voluntarily. Imagine trying to explain the rules of Calvin Ball in a legally binding document. That's how messy things can get if a waiver isn't drafted properly. So always read the fine print and don't be afraid to ask questions if you're unsure about something. It's better to be safe than sorry, right? Because let's be real, sometimes life throws you a curveball and you want to make sure you're not left holding the bag or, in this case, without the coverage you need. Remember, knowledge is power, especially when it comes to navigating the complex world of insurance. Next up, we have warranties. Now, when you think of a warranty, you might picture that little booklet that comes with your new phone or blender, and you wouldn't be wrong. But in the legal world, and especially in insurance, a warranty is more than just a promise that your appliance won't spontaneously combust. A warranty in insurance is a statement that you, the applicant, make that is guaranteed to be 100% true. It's not just your best guess or a vague recollection, it's a factual statement that becomes part of the contract. This is important because if a warranty turns out to be untrue, even if it's an honest mistake, it can be grounds for the insurer to void the agreement. Think of it like this. Let's say you're applying for car insurance and state in your application that your car has never been in an accident. Later, the insurer discovers a fender bender in your car's history that you genuinely forgot to mention. Even though it was an honest oversight because it was a warranty, the insurer could potentially deny a claim or even cancel your policy. The good news is that in most cases, the statements you make on an insurance application are considered representations, not warranties. Representations are statements you believe to be true to the best of your knowledge, but they don't carry the same make or break weight as a warranty. Still, it's always best to be as accurate and truthful as possible when filling out insurance applications. Honesty, as they say, is the best policy, pun intended. And there you have it. We've journeyed through the intricate world of insurance terminology, deciphering everything from adhesion contracts to warranties. Hopefully you've gained a newfound understanding of these key legal concepts and feel better equipped to navigate the often confusing landscape of insurance policies. Remember, knowledge is power, and when it comes to something as important as insurance, understanding the fine print can make all the difference. By demystifying these terms, we hope you feel empowered to make informed decisions about your insurance needs and protect yourself and your loved ones from life's unexpected curveballs. But our exploration of the financial world doesn't end here.